But yeah, today our guest speaker is going to be no other than our leader, Peter Kim, and he will be going over credit repair options and VOE loans. So yeah, please give your undivided attention.
Good morning, everyone. I'm going to talk over the two topics, the credit repair and the written VOE, written verification of employment. I'm going to touch the basis on the written VOE part first. I will share the screen. Do you see this screen?
Yes,
right?
we do.
All right. Today, we're breaking down 3 mortgage programs that show very different approaches to the same problem, providing our ability to repay. We're going to cover FHA VOE, conventional VOE, and conventional 80% and 90% VOE. And by the end, you'll be seeing, you'll see exactly which borrower fits which program. So here's our roadmap. We'll start with a bigger picture, then walk through each program one by one, compare them side by side, and finish with strategy and takeaways. Think of these 3 programs as 3 philosophies. The first, FHA VOE, is built for accessibility, helping credit challenge borrowers through compensating factors. Conventional 80% LTV is designed for high-value, pristine borrowers who can handle strict manual underwriting. And the third, conventional VOE, 90%, a middle ground, offering more leverage, but only if employment stability is airtight. So all 3 serve the same goal, but with very different paths. So let's dive into FHA VOEs. It talks about the structure of accessibility. So minimum credit score is 580. Debt to income goes up to 55% with AUS approval, meaning we plug in the W-2 income, run the AUS, and when you have a green light, we're good to go. So what is the trade-off here? It only works with the W-2 employees, no self-employed, no 1099s, no investment income. If we are trying to use a departing home's rental income, it's not going to work. So, and it relies heavily on compensating factors, which are the first, minimal housing increase. So the new payment of the mortgage cannot be greater than $100 or 5% above what they currently pay. Second is the residual income. So you got to make sure we have enough taxable income after debts, utilities, and all the living expenses. So when we approach with the FHA VOEs, we have to collect how much they were spending on the daily basis at the same time. It's their FHA's way of managing risk while serving borrowers with a weaker credit. So you may wonder, what is the advantage and the limitations? The upside is that you get credit accessibilities, lower credit scores, and shorter wait after the major credit events if there were extenuating circumstances. And the gift funds and assistance are allowed. The downside is only for the primary residences. And unlike the regular FHA transactions, the lifetime mortgage insurance applies, and it's a total block for self-employed and alternative incomes. So FHA VOE works for the best with teachers, nurses, service workers who has steady W-2 income, who's not relied on hourly overtimes and bonuses, and maybe with a lower credit, but ready for home ownership. Conventional 80% verification of employment talks about the flexibility. So let's go into the opposite side. The qualification bars are much higher. Credit scores are starting from 660, but usually in order for us to give the best case pricing, credit score must be greater than 700. And the debt to income ratio is at 49%. Talks about 4 years after bankruptcy, 7 years after foreclosure. So every loan is manually underwritten. So income must be verified with a written VOE form directly from employer. Key is that we giving tree orders the written VOEs. Bonus and overtimes and commissions need 2 years history if we want to qualify. In return, you get the flexibility. Although the loan amount can go up to $4 million, we don't recommend it greater than $1 million at this time because of a high rate. This program can be utilized for primary, second homes, and investment homes. And for those who's trying to use this program for vacation homes, short-term rentals, or even for disabled family members, when the loan amount is lesser than $650,000, we can still classify the transaction as a primary residence. So what is the pros and cons? The pros, it can cover the larger loan limit bigger loan limit. It covers a wider property eligibility, and it can cover up to 6% of the seller concessions, which is the agent and the builder or the seller credit. What is the limitation? Only the pristine credit borrowers qualify. 700 credit plus can apply to get the best case pricing. It's a strict seasoning, so it's not strictly going for the second chance applicants. It needs to be, be ready for the high income W-2 professionals and investors who can prove everything with paper trails. So to be specific here, W-2 professionals who is not receiving full income as W-2 can apply. So for example, anyone who's serving, receiving cash deposits, incomes, alternative incomes can consolidate all into written VOEs and apply. And lastly, conventional 90% loan to value ratio program talks about the enhanced leverage. So this one gives the borrowers more leverage. It's only requiring 10% down, but trade-off is the tighter rules. Income verification must come from a third-party verifier from a company named Veritex. We, Giving Tree Lending, became one of the servicers of the Veritex, so we don't have to wait in line to get the written VOEs. We pay the servicing fee, and we're going to receive the verification through emails and fax. No pay stubs and W-2s are required if the VOE is clean, but you need to have at least 2 years of same employer. Just like the 80% loan to value program, no self-employed or family employment income are allowed, and rental income counts, but only for 75% of the lease, minus TITIA. So the catch here is FHA doesn't allow the departing rental income, whereas the conventional does. So expect these requirements: higher FICO scores, stricter debt to income caps, but bigger reserves, giving us more leverage. So we may approach this specific product to someone like who has $10,000 plus nurses, who has ups and downs with their stability of income, with credit score of 740, for example, can purchase a home with 10% down. So this product strength is, number one, the lower down payment requirement, lesser documentation if the automated VOE through Veritex works. And third, we don't have to juggle with the FHA's high upfront mortgage insurance. Anyone who doesn't want to pay can go and apply this product. And limitation is the strict credit and DTI rules and lower loan limits. Unlike the 80% loan to value product can go up to $4 million, this one only covers up to $2.5 million. But we don't recommend it anything higher than $1 million. I'll share the reasons why on the next slide. So this program is a very good fit for strong credit W-2 borrowers who don't have 20% down, but who don't want FHA's lifetime mortgage insurance. So the quick side-by-side comparison is FHA VOE starts from 580 FICO scores for primary residence, 80% loan to value ratio starts from 660 FICO scores and covers all the type of properties, go up to $4 million. And third, 90% VOE, 700 FICO scores with Veritex written VOEs with more leverage and tighter caps. So three very different programs handle risk management strategically. So what's the point? What's the key? It's not about which program is the best. FHA fits accessibilities with lower credit score applicants. 80% conventional product talks about flexibility, covers everything that we can talk about, we can handle. 90% is identical to 80%, but with lesser down payment. So our job is to know the borrower, match them to the right program, and protect the loan and the transaction. That's how we separate ourselves from other competitors out there. So here's the bottom line. These three programs that we present today talk about three different lending philosophies. If you understand the borrower's profile, the agent, buyers, and the seller's agent, talking about closing time, we can align them to the right program so we can, give them the keys that they want, more open doors for this client while keeping the risk under control. I'm going to go over some pricing options and see what options we have today. So first, expanded guideline, written VOE, give us multiple options RCOM is not recommended because they're asking for us to provide 2 months of bank statement reflecting to the W-2s and the written VOEs. So we go for NMSIs. Par pricing is starting from 6.5, 30 years. When we go for 90% loan to value, as this is a non-QM product, we don't need the mortgage insurance product. No MIs. So this is better in many different cases. Carrington serves it, rate starts at 7.249. It's not much different than the regular high balance conforming. And the FHA VOE, same sales price with a 90% LTV to compare in between the 90% conventional with 90% VOEs. We can go for FHA VIP product. Today's rated at 6.5, 30 years. So you may ask, what do I need to watch out? There are two things that you need to watch out for. One is the 120% of the salary.com's income. Second is the 200% or below of the area median income. So we can make a receptionist making $14,000, $15,000, right, per month. So we have to learn the employer, number of employees he had hired, or establishment date of the company. So for example, even if this tire shop opened up and makes 7-figure income, but if he has started only a year and a half, we cannot use this, job information to apply these programs because the job information must be stable for at least 2 years with the same employer. Some products out there allow you to mix and match, allowing the borrower to provide multiple written VOEs, but we're not going to complicate ourselves. There's so many people already who we can help applying these products. And second, we're not going to apply a San Bernardino condominium purchase. The area median income is only $11,000 a month. So we have to strategically use two different rules before we talk about the debt to income ratio and qualifying loan amount. Any questions on this part? If not, I'm going to move on to the credit repair.